This is the Alhambra Investments Weekly Pulse for the week of April 12th. This is where we talk about significant market events and significant investor mindsets. Joe Calhoun is here, and Joe, it's springtime in South Carolina, and I think you're enjoying that a lot.
Yeah, it's pretty nice. I was out in the yard this morning. It's not always fun. I had to go out and do some weeding, but it's nice to be able to go out in the yard and not break out into a sweat like you do in South Florida. My first spring in a long, long time, and it's pretty nice.
You said in the Pulse this week that investors don't always need to be doing something in the portfolio. And we see a lot of clients come to us with preconceived ideas about what a portfolio should look like. Elaborate on that, please.
Well, I think it's more a matter of they see us on podcasts or they see the things that we write about, and they assume that all the things that we're writing about and talking about have to show up in the portfolio some way. And that's just not always true. A lot of the things that we talk about are interesting and may have long-term consequences, and some of them are just interesting. They're things that we want to talk about because they're interesting to talk about. Listen, most of running a successful portfolio is sitting still and doing nothing. And I think that's a skill that takes a long time to develop. Young investors tend to want to be really active, as you see with things like GameStop, where the thing is bouncing all over the place and people are obviously doing a lot of buying and selling. But as you get older, you discover that maybe there's some value to just sitting still. I think too that if you think about it, if you make a change, if you sell something to buy something, you're just increasing your odds of making a mistake in a lot of ways. You could make a mistake and sell something that continues to go up, or you could buy something that goes down. You could compound the mistake, put it that way. So I think it's best a lot of times to not have any preconceived notions about what the future is going to look like or what your portfolio is going to look like. It's going to look like what the market dictates that it look like.
You know, there's been a lot of hand wringing this year. People are saying, what happens if taxes go up? What happens if they start to tax my 401k? Well, in spite of lots of talk like that last week, nothing really happened.
Yeah, like I said, in the thing, nothing happened last week. I mean, there was just no news. And it's obvious there was no news because the market didn't move. I mean, the 10-year Treasury, I think, changed by a little over 1 basis point last week. That's not even worth mentioning. Yeah, we get these questions a lot from clients and prospects who talk to us about, oh my goodness, what am I going to do about these taxes, about Biden's going to raise my taxes? And I'm like, really? How do you know he's going to raise taxes? How do you know that he's going to be able to get anything through the Senate? I just don't put a lot of thought into things that could happen. Let's wait and see what happens. You don't want to make some big change to your portfolio and then discover down the road that, oh, by the way, taxes didn't change, and you incurred a bunch of costs that weren't really necessary. Just sit still and wait. It'll come to you.
You know, a lot of things seem to be driven by what ifs.
Well, there's nothing wrong with thinking about the what if scenarios. Absolutely nothing wrong with thinking about them. What do we do if, well, put it this way, what is the impact on the economy if corporate tax rates go up? Just to take that as an example, since that seems to be something in the news. Biden's proposal apparently is to go from 21% to 28%. But there's a lot of space between 21 and 28 where you don't know what the effective rate's going to be. I guarantee you this: if they start talking about corporate taxes in the Senate and Congress, lobbyists are going to come out and talk to their Congress people. So by the time they get to 28%, it might be 28, and you might change the effective rate by a couple of percent. It may not matter at all. But the point is, there's nothing wrong with thinking about what might be. Just don't make any changes based on what might be. Observe, don't predict. That's our mantra here.
We saw the conclusion to some of those what ifs last week. Jobless claims, no union at Amazon, more talk about the minimum wage, and none of it had any real effect.
Well, it's in the market. I mean, I think people expect this stuff. Just to take the Amazon example, I don't think anybody really expected that Amazon was going to get unionized. It's a right to work state in Alabama, and I think that in general there was not some huge outcry from Amazon workers wanting to unionize. It was the union going in and saying, we can get you a better deal. Well, the fact is they were getting a pretty good deal from Amazon to begin with. I mean, starting pay at Amazon warehouses in Alabama are $15 an hour, and the average pay for a warehouse worker in the industry is 17 and change. So they're starting people at 15, almost at the average. with no experience whatsoever. So I think a lot of people, I don't think there was any big surprise there. I think that the minimum wage debate, the debate about wages, I think that was what this really boiled down to, was a fear that wages are going to start to rise in a way that affects inflation. Ultimately, there's this fear of this cost push type inflation that we got in the 70s. I don't think it's much of a risk, just simply because unions don't have that much power anymore. Uh, it's one of those things where I suppose if you had gotten the union vote to go, for the union in Alabama, that would have been a big deal. But for it to go against the union, that wasn't a big deal at all. That's the trend. That's what everybody, I mean, unions only represent 10% of the workforce. And the majority of the 10% that they represent are government employees. They just don't represent much in the private sector anymore. So I don't think anybody was surprised by that outcome, put it that way.
Let's talk about three specifics. The first one, ISM non-manufacturing PMI had a new high last week.
Yeah, look, it's a great number, 63 and change, whatever the number was. It's an all-time high. Like I said in the piece, though, I mean, be careful what you wish for. If you think about it, it makes sense, right? If you have a high PMI, well, if it just set a record, at some point it's going to come back down, which is negative. High PMI readings are actually associated with lower future stock returns. You want to be a big buyer of stocks when the non-manufacturing or the manufacturing PMI is, in the 40s, not when it's in the 60s. So it's interesting, I suppose, but again, not anything anybody wasn't expecting. Everybody's talking about this boom coming out of the virus. The boom is going to be largely in the services side of the economy. That's what's been hurting. So the fact that you got a big services number, I don't think is a surprise at all.
All right, talk about the new high in job openings.
Yeah, this dichotomy between job openings and jobless claims is one that Jeff and I have been talking about, and just trying to figure out what's going on. Look, the job openings number, the JOLTS number was a big number, and the quits part of that report was pretty interesting too. Just a positive report. It's just a positive report, almost in all aspects. On the other hand, you got jobless claims last week, back up to 744,000. And it's just this weird thing where we're getting job creation, which, according to the jobs numbers, we're getting job openings according to the JOLTS numbers, and yet people keep filing for unemployment claims, new claims. And I think maybe the key word there is claims. They're claiming unemployment. But filing a claim is not the same thing as getting paid. And I do think that we have, because of enhanced benefits, the extra $300 a week in unemployment and so forth, there is a bigger incentive to sign up to see if you get paid. And of course, knowing too how efficient the government is at the state level and all their unemployment systems and how great they are at catching fraud, well, I would say your odds of getting paid are actually probably pretty good. And so I don't know, maybe the Biden administration created a little demand there on the claim side. I don't know, but I just do know that it doesn't make a lot of sense. I saw something last week, a report, I think it was out of Bank of America, about the number of claims that are actually, being approved versus the ones that are, versus the number of claims. And the number of claims being approved is actually really, really low compared to history. And I think that goes back to this idea that people are filing claims because it's like, well, what have I got to lose? They might pay me. And if they do, then great. If they don't, I haven't lost anything. I'm not sure the claims number means all that much. But again, it's an interesting point. But do you change anything in your portfolio because of it? Well, no, absolutely not.
The last item, the drop in the inventory to sales ratio.
Yeah, the inventory to sales ratio 1.24. That's a wholesale number. It's a very low number. I mean, that number was 1.31 before the crisis hit. 1.34 actually, maybe it was. It was one in the 1.3s anyway. It's come down a lot, and generally we would expect to see that would be an indication that you're going to see a ramp up in production in the future. It probably still means that wholesalers want to ramp up production, or that wholesalers want to build inventory. It doesn't mean that they can. And I think that's it's a very interesting recession we've just had here. It was a supply shock. That's what COVID-19 primarily was. It's not something most people in our business have seen before. In fact, I don't know that I've ever seen one. A supply shock like that is a different type of recession. It's not a demand shock. And so what happens is demand comes back fairly quickly, and it takes time for supply to catch up. And in the meantime, you end up with shortages, which we've all read about, these shortages of chips at the automakers who are shutting down production in various times because they can't get the chips that they need to put cars together. That's just one example. There are plenty of examples of other supplies that are in short supply right now. That'll probably continue, but eventually supply will catch up. That's one of the things I think is driving this fear of inflation as well, is this idea that there's this supply shortage of some of these things. But there's an old saying in the commodities market that the cure for high prices is high prices, meaning that you will draw in production if prices go up, and same thing here. Shortages show up, eventually they'll get resolved. People are not going to the price increases probably are not going to be permanent, put it that way. And frankly, we haven't seen a huge amount of price increases so much as we've seen shortages. But the bottom line is that number probably means that there's going to be a ramp up of production in the future to fill those inventory numbers and raise that inventory to sales ratio a little bit. We just don't know when they'll be able to do it. It's going to be interesting.
Joe, let's go back where we started, that investors don't always need to be doing something in their portfolio. You had a great line in your report that made me laugh. You said that some portfolios you review look like a financial episode of the Hoarders.
Yeah, we offer these free portfolio reviews for anybody that wants us to take a look at what they're doing, whether it's a do-it-yourselfer or whether it's someone who's got a broker or whatever the case may be. And to me, most portfolios that we look at just look like a collection of stuff. There's no obvious strategy there. It's just that they bought things based on whatever it was that was top of their mind that day. Then they kept it. And so they end up with all this stuff that they think is a portfolio or they call a portfolio, but it has no underlying strategy. That's not the way to run a portfolio. You need to have a strategy, an underlying strategy, which in investing is nothing more than a logical asset allocation. It doesn't have to be real complicated. In fact, probably more complicated is worse. Keep it simple, but have a strategy. Don't just be a collector of things. Don't be a hoarder.
Thanks, Joe. We'll talk again next week. And there's more information in Joe's written report. The link is below.